In this video, we are going to look at ratio analysis. So ratio analysis is a way to look at what's happening in a company by comparing the items on their balance sheet and their income statement together in ratios. So the ratios, this is Starbucks that we are looking at here. This is actual Starbucks financial statements from 08 through 11. And so you can see that their balance sheet looks pretty normal. It looks like the one we looked at in the last video. They've got the normal current assets, long-term investments, property, plant, and equipment, accounts payable, short-term portion of short-term debt, and the current portion of their long-term debt, stockholders' equity. And then they have their income statement, cost of goods sold, depreciation, gross income, or called gross margin, operating income, income tax, and finally down here, net income. And so the ratios combine items in the financial statements to get a clue as to how the company is doing. So the ratios are typically divided into 4 different categories: liquidity, asset management, debt management, and profitability. So starting with the liquidity ratios, the definitions are here. So the current ratio is current assets divided by current liabilities. And what that's asking is, do they have enough current assets to pay their current bills if they all came due at once? So ideally you would like this number to be greater than 1 so that you could pay off all your bills and have something left over. So you can see that Starbucks has improved their current ratio from 0.8 up to 1.83 every year. And we compare it to the industry average. So to do a ratio analysis, we need 2 things. We need a time series, so a historical trend, and we also need an industry average to compare it to. So currently we get industry averages either off of yahoofinance.com or Reuters.com has industry averages. Next year we will be getting access to a database online called Robert Morris and Associates Industry Averages. So I can see that this is improving, but until I look at the industry average, I don't really know if it's good. So in the case of a current ratio, bigger is better within a range. And so I don't want a current ratio of 5 because that's too much money tied up in current assets that don't earn money. But a current ratio of 1.83 is good, and it's better than the industry average. The quick ratio is just a variant of this. It subtracts inventory from the current assets. And the idea here is inventory is your least liquid current asset. So if you want to know, do I have enough money to pay my bills, take the inventory out and divide by current liabilities. And again, you would like it to be greater than 1. So again, you see that this has improved steadily over the years and is above the industry average. So there's basically nothing here to worry about in their current asset management. Things look okay. So if we go to the other asset management, so this is going to look at how efficiently are you using your assets. So the first 3 that we're going to look at are current asset management. So inventory turnover is how many times a year do you sell your inventory. Now this is highly industry specific. So if you sell big ticket items like airplane, like a Boeing, your inventory turnover is going to be way lower than this. A grocery store, on the other hand, is going to be higher than this. So it just depends what your inventory is. So again, if we look at the trend, they're sort of been all over the place. It improved and then it took a big dip in 2011, and it's actually the worst that it's been in 2011. And it's well below the industry average. So there's a couple causes for concern here. It's moving in the wrong direction, and it's well below the industry average. So that says that Starbucks is not selling their inventory as much as firms in the industry, and they're not selling them as quickly as they have been in the past. And this is interesting because these particular years are the recession, with 2008 being the start of it and sort of the worst of it, and so by 2011 we're coming out of it. So this is a little surprising to see. Now, one thing that we have to consider is that Starbucks is not exactly like the other firms in its industry. The industry is coffee, it's consumer cyclical restaurants. Okay, so there's a problem. Starbucks is kind of a restaurant, but it's not a great comparison, because Starbucks, in addition to selling coffee, also sells coffee makers and CDs and other items of inventory that most restaurants will not be selling. So perhaps the reason for this difference here is that it's not the best fit for an industry. But there is no industry called coffee shops. And so restaurants is about the best that we can do when we're trying to compare to an industry. So this one maybe is not as bothersome as the fact that this is trending down. Day sales outstanding is how long it takes to collect accounts receivable. So accounts receivable are divided by sales per day, and which is sales over 365. So this is how long your money is tied up in accounts receivable. There isn't even an industry average here. But so accounts receivable are not really a big thing for Starbucks. You would expect the day sales outstanding to be 30 would be a nice one, and because that's the terms most firms offer. Starbucks is well below that, so there's nothing concerning there. Now, a different way of looking at accounts receivable is instead of calculating the days sitting in accounts receivable, we can do like we did with inventory and calculate how many times do you turn your accounts receivable in a year. I prefer the DSO. To me, inventory turnover makes sense. I sell my inventory 12 times a year. But for accounts receivable, days sitting in accounts receivable makes more sense to me, 12 days before I collect my money. This says that we turn our accounts receivable 30 times a year. And you can see that it too, well, it's kind of like the inventory went all over the place. And so was the DSO up here. So it got better, and then it got a little bit worse in 2011 and is way below the industry average. And again, that's probably because Starbucks isn't like most restaurants would not offer accounts receivable at all. And so Starbucks may have some corporate clients that they sell coffee to, and so they do have some accounts receivable. So this is not very concerning to me, but it is curious as to what happened in 2011 that all of these ratios got worse. Now, the fixed asset turnover is how efficiently they're using their fixed assets, so we compare sales to fixed assets. Unfortunately, we do not have an inventory number to compare this to. Not all of our ratios that we calculate are always available in the industry averages. So I can see that it has gotten better. Better is more sales per dollar of fixed assets, so it's been improving every year, so that's good. But I can't for sure tell if it is good without an industry number to compare it to. Total asset turnover, sales divided by total assets. So this includes all that has come before. So when we look at this, we see that this sort of follows the pattern of the current assets. It's down. Well, no, it doesn't. It's just plain down. So it's deteriorated a bit every year, but it's still above the industry average. So there's maybe a little concern here. Why are these ratios trending down? And they seem to be primarily caused by the current assets because the fixed asset ratio was getting better. Okay, so they're not turning their inventory fast enough. Accounts receivable probably aren't a problem, so it's mainly an inventory thing, it looks like. But they are still above the industry average slightly. So there's nothing terribly concerning here. On the debt management ratio, we're asking the question, is the debt a burden for Starbucks? And so long-term debt divided by equity, total debt divided by equity, and then total debt divided by total assets are three different measures of the debt burden. So now these numbers are whole numbers here, but these numbers are percents, and these are decimals, so they also can be converted into percent. So the way we interpret this is Starbucks long-term debt to equity has fallen from 39% to 20%, as opposed to 54% for the industry average. So it's trending in the right direction, and it's well below the industry average, so this certainly does not look like they have too much debt. Total debt, which includes the short-term debt to equity, has gone from being over 1, having more debt than equity, down to 68%, compared to an industry average of 81%. And so again, trending in the right direction below the industry average. We have no average for this one, but this tells what proportion of the total assets are financed with debt. And so you can see in 2008, over half of their assets were financed with debt, and they've got it down to 40% by 2011. Now, the times interest earned ratio, TIE times interest earned, looks at the income statement rather than the balance sheet and says, is this debt burdensome? And so we take earnings before interest and taxes divided by interest expense. And what that is telling you is how many times can you cover your interest expense. So you can see that Starbucks is covering their interest expense no problem. So while their debt has been falling, obviously the burden has been decreasing as well, and they can cover their interest expense 55 times versus 3 times for the industry average. So this is definitely moving in the right direction, and they have way less debt than the industry average. We might conclude that Starbucks actually could use more debt and improve their return to shareholders. Finally, the profitability ratios focus mainly on the income statement and then compare to items on the balance sheet down here. So gross margin is looking at gross margin, which is sales minus cost of goods sold divided by sales. So this is saying, what is your gross margin percent? Are your cost of goods sold too high? And so when we look here, the gross margin percent has been improving and is a little bit below the industry average, 53% versus 58%. Okay, and again, that could be due to the things like coffee makers maybe that increase their cost of goods sold. So not too concerning there, it's moving in the right direction. Operating margin is operating income divided by sales. Operating income is also called EBIT, earnings before interest and taxes. And so this has improved from 4% to 13% compared to 7.8% for the industry average. So they're doing really well here. Profit margin, net income divided by sales, this is called the bottom line. And so their profit margin is up from 3% to 11% compared to only 4.68 for the industry average. So in fact, they are doing quite well. Now, ROA and ROE. ROA is return on assets, net income divided by total assets. And so their ROA has improved from 6% to 17 compared to 7.5 for the industry average. So that's saying we've got this base of assets. What return are we earning on this base of assets? And we're earning a 17% return. Return on equity is 13, 26, 28 compared to 14.5 for the industry average. So that's very good. Now, overall, I would start an analysis down here because return on equity is the single most important ratio. So Starbucks is doing very well in the return on equity area. They've got a 28% return on equity. That's a return to their shareholders on their investment in the company, which is twice the industry average. And that's coming about because they have a healthy profit margin, not because they are selling lots and lots of coffee, but because they have a healthy profit margin. So it's mainly driven by the profit margin. But really, there's nothing to concern me up here. We had some questions about why is the inventory turnover trailing down, and so that's something we would want to investigate, but really that's pretty much the only thing that we see here that would trouble us. So that's what we use the ratios for, is to try and get a deeper understanding of how is the company doing. Now, if you remember in the last video, I talked about market value added. And that is the market value of the stock minus the book value of the equity. And so up here at the top, on this particular day, the stock price was $47.71, and there were 745 million shares outstanding. So their market cap was $35 billion. And so that's price times shares is $35 billion. And then their stockholders' equity on their balance sheet, this is also in thousands, was $4 billion. So when we look at the market value of equity minus the book value, Starbucks has created $31 billion in value. So shareholders have invested either directly or through retained earnings $4.387 billion, and Starbucks has turned that into a market value of $35.56 billion. So they have created $31.175 billion in wealth. So market value added is a really nice statistic to compare companies and basically say, what have you done for the economy? And so Starbucks has done quite well.